action. We're joined by Jeremy Batstone-Carr, Head of Client Research at Charles Stanley Co. Jeremy, thank you so much for coming in.
Pleasure, thank you.
There is a lot of risk being taken off the table because investors are just concerned about everything and anything, I guess. We don't really know what the banks will have to take in terms of write-downs. We don't even know at this point if the US will be able to reach an agreement on the debt deal. And in Europe, that package that was hailed as, you know, a big winner last week is looking a little bit less like the shock and awe we were expecting.
Yes, I find myself continually contrarian, bearish when many are bullish and bullish when many are bearish. I think that we take the view that there will be a last minute, and we are talking absolutely last minute settlement to the US debt crisis, and I think that there will be a knee-jerk positive reaction from the financial markets to that, particularly the equity markets. Bonds I'm not so sure about. Therefore, peculiarly, and perhaps the reason why we're seeing a sell-off today in the equity markets, but not a profound sell-off, suggests to me that maybe some investors are actually looking to take on some risk on the assumption that the US authorities will find a solution at the 11th and a half hour.
Now, if they take, if they find a solution for the debt deal, even at, 11:55 on the August the 2nd, will it be on something for the next couple of months, or will it be longer term? Because that's the key, isn't it?
Well, that's right. A short-term increase in the debt ceiling solves nothing. The Global Economist magazine debt clock has just ticked up to $42 trillion. It's a bit like partying when the ceiling you're partying under is about to cave in. That's right. So this solves nothing over the medium to longer term. We kick the can down the road, a popular saying. It gives authorities a little bit of breathing room. There may be a relief rally if this happens, which we think it probably will. Thereafter, of course, we'll be back to the same old concerns. How do you find a lasting long-term solution? And we're nowhere near that, either in US or Europe.
But so, Jeremy, what kind of a rally are you expecting? Are we talking 2-3%, even more? And would today be a good time to buy? We see a lot of lows for a lot of these European indices.
Yes, I think that today would be a reasonably good time to buy. I don't think that we have necessarily seen the bottom, but I think we are closer to the bottom than the top. Equity markets have by and large traded in a fairly well-defined, if wide, range all year. The bottom of the range supported by valuation and, of course, earnings. The top of the range, of course, impacted by macro outlook and geopolitical uncertainty. I think that we're not going to move away from that.
But what would you actually be buying in today's trade? Are we talking about broad indices, sectors? You wouldn't be buying banks, would you?
I wouldn't be buying banks, but only because we're heading into the European reporting season, as you have mentioned, and there is so much uncertainty out there. We're very cautious on the banking sector and are extremely underweight, I may say. But I certainly wouldn't mind having a bit of exposure to pro-cyclical growth right now, because I sense that if there is to be a rebound in the market, those sectors will rebound strongest, fastest. But it's a short-term trade, because with nothing solved over the medium to longer term, you can't criticize any investor for maintaining a fairly defensive core within their portfolios, and of course having a smattering of gold, which is a play on dollar weakness.
Would you be buying any gold? And would you be buying, Jeremy, any of these periphery bonds? Why not?
Well,
you'd have to have a strong stomach to buy some of these, right?
That's right, because the thing that concerns me about the Eurozone crisis is that having made such headway, yes, there's criticism. Of course, the German people are extremely concerned about how much they might be in it for. What we now discover is that some of these key details won't actually be thrashed out until the autumn. Now, the market's going to hate that uncertainty, and my sense is that the authorities should have taken the initiative and continued to drive things through, but nothing stops a European politician from their summer, I guess. But yes, we would be adding a bit of gold right now for sure, as a hedge against continued dollar weakness, and we would be buying pro-cyclical growth, and we're very, very wary about sovereign bond markets. Real interest rates, of course, are negative, so we prefer equities to bonds.
All right, Jeremy, thank you so much. A pleasure to have you in the studio.
Thank you.